Every 7 years, like clockwork, the lending machine shifts gears. Not perfectly timed, never exactly predictable, but the rhythm is there if you know where to look. Credit flows, then tightens, then collapses, then rebuilds. The cycle spins forward, driven by forces that most borrowers never see until it's too late. Understanding this pattern isn't about predicting the future with certainty. It's about recognizing when opportunity opens and when danger lurks just beneath the surface of seemingly healthy markets. The patterns stretch back decades, visible in the wreckage of previous expansions and contractions. Each cycle carries its own unique characteristics, its own triggers and breaking points, but the underlying mechanics remain remarkably consistent. Lenders extend credit when confidence runs high, borrowers leverage themselves to the hilt when money flows freely, and eventually the system buckles under the weight of its own excess. Then comes the cleanup, the tightening, the rebuilding of balance sheets, and then, inevitably, the whole process begins again. For business owners deciding whether to take on debt, for real estate investors timing their acquisitions, for anyone whose livelihood depends on access to credit, understanding these cycles isn't academic. It's the difference between expanding when capital is cheap and available versus finding yourself over-leveraged just as the music stops. The difference between buying property at the peak versus waiting for the inevitable correction. The difference between thriving and merely surviving. Let's trace this pattern from 1980 forward, watching how credit conditions evolve through multiple complete cycles. Not to predict exactly when the next crisis will strike, but to understand the signs that precede expansions and contractions. To see how lending standards deteriorate during booms and tighten during busts. To recognize when we're approaching inflection points that separate winners from casualties. The story begins in 1980 with Paul Volcker, at the helm of the Federal Reserve, interest rates climbing toward levels never seen before or since. The federal funds rate had been hovering around 11% through much of 1979. But Volcker wasn't satisfied. Inflation was raging, touching double digits, eroding purchasing power and threatening the entire economic structure. So Volcker did something dramatic. He pushed rates higher, ultimately reaching 20% by 1981. This was monetary medicine administered with no anesthetic, designed to break the back of inflation regardless of the pain it caused. For borrowers, the impact was immediate and brutal. Anyone with floating rate debt watched their interest payments triple. Companies that had borrowed heavily during the late 1970s suddenly found themselves unable to service obligations that had seemed manageable just months earlier. Real estate investors who had leveraged properties at 8 or 9% rates now faced refinancing at 15 or 18%. The credit expansion of the 1970s slammed into reverse. But the real devastation hit the developing world. During the 1970s, Latin American countries had borrowed enormous sums from American and European banks. The lending had been fueled by petrodollars, as oil-exporting nations deposited their surpluses in Western banks, which then needed to lend those funds out to earn returns. Latin America, with its growing economies and natural resources, seemed like a safe bet. Between 1975 and 1982, the region's external debt had quadrupled from $75 billion to over $315 billion, representing about 50% of these countries' combined gross domestic product. The loans carried floating rates tied to LIBOR, the London interbank offered rate. When Volcker pushed American rates skyward, LIBOR followed. Latin American debt payments exploded. Countries that had been making interest payments of $12 billion in 1975 now owed $66 billion annually by 1982. The economics became impossible. These nations had borrowed assuming growth would continue, commodity prices would remain high, and interest rates would stay manageable. Instead, growth stalled, commodity prices collapsed as global recession took hold, and interest costs tripled. On August 12, 1982, Mexico's finance minister contacted the Federal Reserve, the Treasury Department, and the International Monetary Fund with news that would trigger the worst debt crisis since the Great Depression. Mexico could not make its upcoming payment. The country needed emergency assistance immediately. Within weeks, 16 other Latin American nations announced similar problems. By the end of 1983, 27 countries representing $239 billion in debt were either in default or restructuring. The crisis threatened to destroy the American banking system. The 9 largest US money center banks had lent Latin America amounts totaling 176% of their capital. If these loans defaulted completely, the banks would be insolvent. A banking collapse of that magnitude would have cascaded through the entire global financial system. Federal regulators granted forbearance, allowing banks to avoid taking losses they couldn't absorb. The International Monetary Fund stepped in with restructuring programs that kept interest payments flowing while stretching out repayment schedules. Latin American countries were forced to implement austerity programs, cut spending, privatize state assets, and open their markets to foreign investment in exchange for the loans that prevented complete default. This was the first major credit contraction of the modern era we're examining. The pattern is instructive. During the expansion phase of the 1970s, lenders had competed aggressively for market share, extending credit to increasingly risky borrowers at narrowing interest rate spreads. Lending standards had deteriorated as banks assumed growth would continue indefinitely. When conditions shifted, when Volcker's rate hikes changed the equation, the entire structure collapsed rapidly. Countries that had been considered creditworthy one month were unable to pay the next. For business owners and investors watching this unfold, the lesson was clear. When credit becomes easy, when lenders are competing to put money out the door, when borrowing costs are low and terms are generous, that's when danger accumulates. Not immediately, not obviously, but systematically. The easiest credit often comes just before the hardest times. The Latin American debt crisis marked the low point of that credit cycle. From 1982 through the mid-1980s, international lending remained constrained, banks rebuilt their capital positions, and borrowers deleveraged. But by 1985 and 1986, memories were fading and credit was beginning to flow again. This time the excess would build in a different sector, creating the savings and loan crisis that would devastate America's thrift industry. Savings and loan institutions had existed for over a century, funding home mortgages by taking deposits from local savers. Their business model was simple but vulnerable. They borrowed short and lent long, taking in deposits that could be withdrawn at any time and making 30-year fixed-rate mortgage loans. When interest rates were stable, this worked fine. When rates exploded in the late 1970s and early 1980s, it became catastrophic. S&Ls were paying double-digit rates to attract deposits, while their mortgage portfolios still earned the single-digit rates from loans made years earlier. They were losing money on every transaction, bleeding capital that couldn't be recovered. By 1982, the industry was technically insolvent. The Federal Savings and Loan Insurance Corporation, which insured thrift deposits, didn't have enough money to close all the failing institutions without itself going bankrupt. Regulators faced an impossible choice: close the insolvent thrifts immediately and trigger financial panic, or grant forbearance and hope the institutions could grow their way out of trouble. They chose forbearance. In 1980 and 1982, Congress passed legislation deregulating the S&L industry, allowing thrifts to make riskier loans in commercial real estate, junk bonds, and speculative ventures. The theory was that higher risk, higher return investments would restore profitability. The reality was that it gave failing institutions with nothing to lose the ability to gamble with federally insured deposits. The credit expansion that followed was reckless on a scale hard to overstate. S&Ls in Texas, California, and other states grew their assets by over 100% between 1982 and 1985, far above the national average. They were making loans to anyone who asked, with minimal documentation, inflated appraisals, and insider dealing. Developers could get 100% financing for speculative projects that had no realistic chance of success. The incentives were completely misaligned. If the loans paid off, the S&L executives collected fees and bonuses. If they failed, the federal government absorbed the losses through deposit insurance. By the late 1980s, the accumulated losses were too large to hide. Major thrifts began failing in spectacular fashion. Charles Keating's Lincoln Savings and Loan collapsed in 1989, costing taxpayers $3.4 billion in one of the largest single failures. The scandal involved 5 US senators who had received campaign contributions and intervened with regulators on Keating's behalf. This became known as the Keating 5 scandal, highlighting how political connections had enabled the excesses to continue long after problems were obvious. In 1989, Congress finally confronted the crisis directly with the Financial Institutions Reform, Recovery and Enforcement Act. The Federal Home Loan Bank Board was abolished, S&L Deposit Insurance was placed under the FDIC, and the Resolution Trust Corporation was created to manage and sell assets from failed institutions. Between 1989 and 1995, the RTC closed 747 thrifts, with total assets exceeding $400 billion. The ultimate cost to taxpayers reached $124 billion. The S&L crisis demonstrates how credit cycles feed on themselves during the expansion phase. Initial losses are covered up through regulatory forbearance and accounting tricks. Desperate institutions make increasingly risky loans, gambling for redemption. Real estate markets inflate as speculation intensifies. Eventually reality reasserts itself, loans default in waves, and the cleanup costs far exceed what early intervention would have required. For commercial real estate investors, the late 1980s had looked like opportunity. Credit was flowing, properties were appreciating, and developments were getting funded with minimal equity required. But those who loaded up on leverage between 1985 and 1988 found themselves underwater by 1990 and 1991. Properties bought at peak prices with 90 or 100% financing couldn't be refinanced as the credit window slammed shut. Foreclosures spiked, values crashed, and equity evaporated. The cycle had turned, and the lesson was harsh. Easy credit at the peak of a cycle destroys wealth more effectively than any market correction by itself. The early 1990s marked another credit contraction and reset. Banks tightened lending standards dramatically after absorbing losses from commercial real estate and leveraged loans. But by 1993 and 1994, credit conditions were easing again. The Federal Reserve had lowered rates to stimulate recovery from the 1990 to 1991 recession. Alan Greenspan's Fed was keeping monetary policy accommodative, and a new credit expansion was building. This time, the excess would accumulate in emerging markets and in increasingly complex financial instruments. The mid-1990s saw massive capital flows into Asia, Russia, and Latin America as investors sought higher returns than developed markets were offering. At the same time, hedge funds and investment banks were developing sophisticated strategies that relied on enormous leverage and tiny spreads between related securities. Long-term capital management was the poster child for this approach. Founded in 1994 by John Merriweather, the former Salomon Brothers bond trader LTCM attracted an all-star team, including 2 Nobel Prize-winning economists. The fund's strategy involved identifying securities that were mispriced relative to each other, buying the cheap one and selling the expensive one, then waiting for the spread to normalize. Because the profits on each trade were tiny, LTCM used massive leverage, borrowing more than $125 billion against equity capital of about $5 billion, a leverage ratio of 25-1. For 3 years, the strategy worked brilliantly. LTCM generated returns of 43% in 95 and 41% in 1990. But the fund's models assumed that markets would behave rationally, that spreads would mean revert, that historical correlations would hold. Those assumptions didn't account for what happened in 1998. The Asian financial crisis had begun in July 1997, when Thailand devalued its currency, triggering contagion across the region. By 1998, the effects were still rippling through global markets. Then on August 17th, Russia defaulted on its domestic debt and devalued the ruble. This shocked financial markets. According to traditional economic theory, a country with a printing press should never need to default on debt denominated in its own currency. Russia's default broke that assumption. Investors fled to safety, bidding up the prices of the most liquid treasury securities while selling less liquid assets. This was exactly the opposite of what LTCM's models predicted. The fund had been short liquid treasuries and long illiquid bonds, expecting the spread to narrow. Instead, it widened dramatically. In September 1998, LTCM lost $4.6 billion in equity value, its capital dropping from over $4 billion to less than $600 million in just weeks. The Federal Reserve Bank of New York orchestrated a bailout on September 23rd, convincing 14 major banks to inject $3.6 billion in exchange for 90% of the fund's equity. The Fed didn't provide direct financing, but its involvement sent a clear message about systemic risk. LTCM was leveraged with every major Wall Street firm. If it failed, the forced liquidation of its positions could have created a cascade of defaults across the global financial system. The 1998 crisis revealed how credit cycles had evolved. It wasn't just traditional bank lending anymore. Hedge funds, investment banks, and other shadow banking institutions were creating massive leverage through derivatives and repo financing. The credit expansion was happening in markets that regulators didn't fully understand or monitor. When those positions unwound, the systemic risk rivaled traditional banking crises. For business owners and investors, 1998 demonstrated that credit cycles affect more than just borrowing rates. When leverage players are forced to liquidate, it impacts asset prices across the board. Commercial real estate values dropped as pension funds and insurance companies pulled back from property investments to cover losses elsewhere. Corporate bond spreads widened dramatically, making refinancing more expensive even for creditworthy companies. The credit contraction hit everyone, not just those who had been over-leveraged. The response to the 1998 crisis set the stage for the next expansion. The Federal Reserve cut rates aggressively, lowering the federal funds rate from 5.5% to 4.75% between September and November 1998. Credit conditions eased quickly, and by 1999 the economy was accelerating again. But the next credit expansion would build in technology stocks and telecommunications, creating a bubble that would burst spectacularly in 2000. The dot-com boom had been building since the mid-1990s as the internet commercialized, and investors became convinced that traditional valuation metrics no longer applied to technology companies. Venture capital flooded into startups that had no path to profitability, but plenty of growth potential. Companies went public with astronomical valuations based on revenue growth alone, ignoring the fact that most were burning cash at unsustainable rates. Credit fueled the boom in multiple ways. Venture capitalists borrowed to invest in startups. Investors bought stocks on margin, leveraging their portfolios. Companies issued junk bonds to finance expansion even while losing money. Telecommunications firms borrowed billions to build fiber optic networks that would ultimately carry only a fraction of their capacity. By early 2000, the Nasdaq index had risen from 751 in January 1995 to over 5,000, an increase of more than 500% in 5 years. The bubble burst in March 2000. Multiple factors contributed, but rising interest rates played a key role. The Federal Reserve had been tightening monetary policy throughout 1999 and early 2000, concerned about inflation and asset price speculation. By May 2000, the federal funds rate stood at 6.5%, up from 4.75% just 18 months earlier. The higher rates made borrowing more expensive and changed the calculation for investors. Why take enormous risk on profitless tech companies when Treasury bonds were yielding over 6%? On March 10, 2000, the Nasdaq peaked at 5,048. Over the next 30 months it would fall to 1,114, a decline of 78%. The crash destroyed more than $5 trillion in market value. Dot-com companies that had raised hundreds of millions through IPOs burned through the cash and went bankrupt. Pets.com, Webvan, and eToys became symbols of excess speculation. Even companies that survived like Amazon and eBay saw their stock prices drop by more than 80%. The credit contraction that followed was relatively mild compared to previous crises, partly because the Federal Reserve responded quickly. Between January and August 2001, the Fed cut rates 11 times, lowering the federal funds rate from 6.5% to 3.5%. These cuts were designed to cushion the economy as the tech bubble deflated. The September 11th attacks accelerated the stock market decline and prompted additional rate cuts. By the end of 2001, the federal funds rate stood at 1.75%. What happened next would create the largest credit bubble in history. The Federal Reserve kept rates extraordinarily low from 2001 through 2004, eventually reaching 1%. This easy money policy was intended to support recovery from the 2001 recession, but it also unleashed a massive credit expansion focused on residential real estate. With Treasury bonds yielding barely more than 1%, investors sought higher returns in mortgage-backed securities. Banks competed aggressively to originate mortgages they could package and sell to investors. lending standards deteriorated at an alarming pace. The housing credit expansion from 2003 to 2006 was remarkable for how systematically it abandoned traditional safeguards. In previous decades, mortgage lending required documented income, verified employment, substantial down payments, and conservative debt-to-income ratios. By 2006, these requirements had largely disappeared. Borrowers could get stated income loans, nicknamed liar loans, with no documentation required. They could obtain mortgages with zero down payment, sometimes even borrowing the closing costs. Adjustable rate mortgages with initial teaser rates of 2 or 3% would reset to 8 or 9% after 2 years, but lenders assured borrowers they could refinance before the reset using home price appreciation. Subprime mortgages grew from 5% of total originations and $35 billion in 1994 to 20% and $600 billion in 2006. These loans targeted borrowers with poor credit histories, limited income, or both. The theory was that rising home prices would protect lenders even if borrowers couldn't make payments. If someone defaulted, the lender would foreclose and sell the property for more than the loan amount. It was a theory that only worked if prices kept rising. Investment banks created increasingly complex securities backed by these mortgages. Collateralized debt obligations bundled mortgage-backed securities into tranches with different risk levels. The rating agencies gave AA ratings to securities that ultimately proved nearly worthless. Banks sold these securities to pension funds, insurance companies, and foreign investors who trusted the ratings without understanding the underlying mortgages. The financial system became interconnected in ways that made the eventual crisis systemic rather than isolated. By 2006, US home mortgage debt had reached 73% of GDP, up from 46% in the 1990s. Total mortgage debt had nearly doubled from 2001 to 2007, reaching $10.5 trillion. Home equity extraction, where homeowners borrowed against appreciated values, reached 11.5% of GDP by 2005. The economy had become dependent on housing credit growth to sustain consumer spending and overall economic expansion. Home prices peaked in mid-2006 and began declining. At first, the deterioration seemed manageable, concentrated in states like Florida, Nevada, and California that had experienced the most speculation. By early 2007, subprime mortgage lenders were failing. New Century Financial, one of the largest subprime originators, filed for bankruptcy in April 2007. But most observers believed the problems would remain contained to subprime borrowers and wouldn't spread to prime mortgages or the broader economy. That belief was shattered in August 2007 when credit markets seized up globally. BNP Paribas, a major French bank, froze 3 investment funds because it couldn't value the mortgage-backed securities they held. There was no market for these assets, no way to determine what they were worth. Within days, other banks revealed similar problems. The securitization market that had funded trillions in mortgages essentially shut down. Banks stopped trusting each other, unwilling to lend even overnight because they didn't know which institutions held toxic mortgage assets. The Federal Reserve and other central banks injected liquidity to keep credit markets functioning, but the crisis continued to intensify throughout 2008. Bear Stearns, the 5th largest US investment bank, nearly collapsed in March and was sold to JP Morgan Chase with Federal Reserve financing. In September, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history. The same week, Merrill Lynch was sold to Bank of America to avoid a similar fate. AIG, the insurance giant, required a government bailout exceeding $180 billion after writing credit default swaps on mortgage securities. The financial system was in free fall. The credit contraction that followed was the most severe since the Great Depression. Banks tightened lending standards across all categories. Business credit lines were cut. Commercial real estate financing dried up. Consumer credit card limits were slashed. Mortgage lending became nearly impossible outside of government-backed programs. The unemployment rate climbed from less than 5% to 10%. GDP declined 4.3% from peak to trough. Housing prices fell 30% nationally and more than 50% in some markets. Government response was unprecedented. The Federal Reserve lowered the federal funds rate to near zero and kept it there for 7 years. It implemented quantitative easing, purchasing more than $4 trillion in Treasury securities and mortgage-backed securities. The Treasury Department provided capital injections to major banks through the Troubled Asset Relief Program. Congress passed fiscal stimulus packages totaling over $1 trillion. These interventions prevented the crisis from becoming a second Great Depression, but recovery was painfully slow. The credit cycle reached its bottom between 2009 and 2011. Credit was extraordinarily tight, banks were rebuilding capital, and borrowers were deleveraging. Corporate bond spreads were wide, mortgage rates were low, but lending standards were strict, and commercial real estate values were depressed. For investors with capital and creditworthiness, this was the opportunity of a decade. Properties could be purchased at 40 or 50% discounts from peak prices. Companies desperately needed capital and were offering favorable terms, but most potential buyers were over-leveraged themselves or couldn't access credit to execute transactions. The expansion phase that followed was different from previous cycles. Credit growth was slow and uneven. Banks remained cautious, regulators implemented stricter capital requirements, and borrowers were wary after the crisis. The Federal Reserve kept rates near zero until December 2015 and only raised them gradually thereafter. Credit gradually became easier, but the pace was measured compared to the reckless lending of the mid-2000s. By 2019, the credit expansion had been running for a decade. Corporate debt had grown substantially, reaching record levels relative to GDP. Leveraged loans and high-yield bonds were trading at tight spreads, indicating investors were comfortable with credit risk. Commercial real estate prices had fully recovered and were setting new records. Lending standards had eased significantly, though not to the extremes of 2006. Covenant-light loans, which gave borrowers more flexibility and lenders less protection, had become standard in the leveraged loan market. Then came 2020 and a credit shock unlike anything the modern financial system had experienced. The COVID-19 pandemic forced lockdowns that shut down large sectors of the economy virtually overnight. Airlines stopped flying, hotels emptied, restaurants closed, and retailers shuttered. The economic impact wasn't the result of financial excess or credit bubbles. It was an external shock that hit with unprecedented speed. Credit markets seized up in March 2020. Corporate bond spreads widened dramatically as investors fled to Treasury securities. The median investment-grade corporate bond spread jumped from around 100 basis points at the start of the year to over 400 basis points by mid-March. Even credit-worthy companies faced trouble rolling over debt. The commercial paper market, where companies finance short-term working capital needs, essentially froze. The Federal Reserve's response was more aggressive than in any previous crisis. On March 23, 2020, it announced an array of programs including facilities to purchase corporate bonds directly in both primary and secondary markets. The Fed said it would buy investment-grade corporate debt and even extend eligibility to recently downgraded fallen angel issuers. It expanded the commercial paper funding facility and created programs to support municipal bonds and asset-backed securities. These announcements stabilized markets immediately. Credit spreads began tightening even before the Fed made substantial purchases. The COVID credit event demonstrated how quickly conditions can change and how dependent markets have become on Federal Reserve support. Within weeks, companies had gone from easy financing to potential bankruptcy to renewed access to capital markets, all based on central bank intervention. Firms issued record amounts of bonds during the second quarter of 2020, taking advantage of Federal Reserve backstops to lock in multi-year financing at attractive rates. Corporate debt issuance during 2020 exceeded previous records as companies borrowed to survive shutdowns and took advantage of Fed programs to secure long-term financing. Investment-grade companies issued over $2 trillion in bonds during the year. High-yield issuance reached record levels as riskier companies accessed markets they had been locked out of during March. The credit expansion was driven by policy rather than private market forces, but the effect was real. Companies that should have faced financial distress secured financing to survive and eventually thrive as economies reopened. By 2021 and 2022, credit conditions had normalized and in many ways become exceptionally loose. Private credit, direct lending by non-bank institutions grew explosively as pension funds and insurance companies sought higher yields. Leveraged buyouts reached record volumes as private equity firms took advantage of cheap financing. Real estate investors bid property prices to new highs, supported by mortgage rates below 3% for much of 2021. Then, in 2022, the Federal Reserve began the fastest rate hiking cycle in 40 years. Inflation had surged above 9%, driven by supply chain disruptions, fiscal stimulus, and accommodative monetary policy. Starting in March 2022, the Fed raised rates at every meeting, increasing the federal funds rate from near 0 to 5.5% by July 2023. This was a monetary tightening comparable to Volcker's actions 4 decades earlier, though starting from a much lower base. The impact on credit markets was significant but uneven. High-yield bond spreads widened, but not dramatically. Investment-grade corporate borrowers largely refinanced ahead of rate increases, locking in low rates for years. The real pressure built in areas dependent on floating-rate debt and short-term refinancing. Commercial real estate, particularly office properties, faced a double shock of rising rates and declining demand as remote work reduced office utilization. Regional banks that had made commercial real estate loans saw their asset values decline as property prices fell. Silicon Valley Bank's failure in March 2023 highlighted vulnerabilities in the financial system. The bank had invested heavily in Treasury securities and mortgage-backed securities when rates were low. As rates rose, the value of those securities fell sharply. When depositors began withdrawing funds, SVB had to realize losses on securities it had planned to hold to maturity. Within 48 hours, the 16th largest US bank had collapsed. 2 other regional banks failed in quick succession. The Federal Reserve and FDIC intervened to guarantee uninsured deposits and prevent broader contagion. As we move through 2024 and into 2025, the credit cycle is in an interesting position. Interest rates remain elevated compared to the post-2008 period, but have begun to decline as inflation moderates. The Federal Reserve cut rates in September 2024 and continued cutting through the end of the year, bringing the federal funds rate down to around 4.5%. Credit markets have remained resilient, with spreads staying relatively tight despite higher base rates. Corporate fundamentals are generally solid, with most companies having termed out debt at low rates before the hiking cycle began. Looking toward 2026, several factors will shape credit conditions. A maturity wall is approaching in high-yield bonds and leveraged loans, with over $620 billion coming due in 2026 and 2027. Companies will need to refinance this debt at significantly higher rates than when it was originally issued. For some borrowers, particularly those in sectors facing structural challenges, the higher interest burden may prove unsustainable. Default rates are expected to rise from the unusually low levels seen during the Federal Reserve's intervention period. Geopolitical tensions add uncertainty to the credit outlook. Trade conflicts, regional wars, and political instability create risks that markets are not fully pricing. A shock from any of these sources could tighten credit conditions rapidly. At the same time, monetary policy appears to be moving toward easing, which historically supports credit markets. The balance between these factors will determine whether 2026 sees credit conditions continue their current stability or shift toward stress. Historical patterns suggest caution. We are now 15 years removed from the bottom of the financial crisis credit cycle. The post-2008 expansion has been the longest in modern history, interrupted only briefly by the COVID shock that was met with immediate and massive policy support. Credit cycles don't die of old age, they require a catalyst. But long expansions tend to create vulnerabilities that make systems fragile when stress arrives. Leverage has built up in corporate America, particularly in middle-market companies financed by private credit. Commercial real estate faces significant repricing, as properties financed at 3% need to refinance at 6 or 7%. Consumer credit card delinquencies are rising, particularly among younger borrowers. For business owners, real estate investors, and borrowers evaluating decisions in 2025 and 2026, several lessons emerge from 4 decades of credit cycles. First, the time to borrow and lock in rates is during the early and middle stages of credit expansions, not at the peak when terms are easiest but danger is highest. Companies that termed out debt at low fixed rates in 2020 and 2021 are in far better positions than those who waited or remained on floating rate debt. Real estate investors who bought properties in 2010 through 2014 and locked in long-term, low-rate financing built equity through appreciation and rental growth, while their debt costs stayed fixed. Those who bought in 2021 and 2022 at peak prices with shorter-term debt now face refinancing at much higher rates into a softer market. Second, credit availability is a more important indicator than credit cost. When lenders are competing to put money out, when underwriting standards are loosening, when terms are becoming more borrower-friendly, that signals late-cycle conditions. The easiest money comes just before the hardest times. Conversely, when credit is tight but starting to ease, when lenders are selectively returning to markets after a period of withdrawal, those are often the best times to borrow for credit-worthy borrowers who can access capital. Third, the credit cycle impacts more than just borrowing decisions. It affects asset prices, exit opportunities, and business strategy. Selling a business or property during credit expansion means buyers can access leverage to bid prices higher. Selling during credit contraction means buyers need more equity, reducing what they can pay. Expanding capacity or entering new markets works better when credit supports growth across the economy. Consolidating and focusing on core strengths makes sense when credit conditions are tightening. Fourth, Federal Reserve policy is the dominant force shaping credit cycles in the modern era. When the Fed cuts rates aggressively and keeps them low for extended periods, credit expands. When it raises rates quickly and keeps them elevated, credit contracts. But there are always lags. It takes time for rate changes to flow through to the real economy. The Fed began raising rates in early 2022, but the full impact won't be felt until 2025 and 2026 as debt matures and refinances at the higher rates. Understanding these lags helps with timing decisions. Fifth, credit cycles vary in their specific manifestations, but follow consistent patterns. The expansion phase features loosening standards, narrowing spreads, increasing leverage, and growing confidence. The peak features the easiest credit terms and the most aggressive lending. The contraction features tightening standards, widening spreads, deleveraging, and loss of confidence. The trough features tight credit despite low interest rates, as lenders rebuild capital and borrowers repair balance sheets. Each phase offers different opportunities and risks. The challenge for 2026 is that we're seeing mixed signals. Credit spreads remain tight, suggesting confidence, but specific sectors show stress. High-yield default rates are rising from extremely low levels. Commercial real estate, particularly office properties, faces significant challenges. Consumer credit quality is deteriorating. At the same time, most corporations are well positioned with termed-out debt, unemployment remains low, and economic growth continues, albeit at a moderate pace. Research suggests that credit cycle inflection points often occur around 7-year intervals, though this is an average rather than a precise prediction. The pattern reflects the time it takes for memories of previous crises to fade, for new leverage to accumulate, for lending standards to deteriorate, and for excesses to build to unsustainable levels. From this perspective, we are roughly 7 years from the COVID credit shock of 2020, though that event was so brief and was met with such aggressive policy support that it may not have purged excess from the system the way traditional credit contractions do. Looking at longer cycles, we are 15 years from the depths of the financial crisis in 2009. Multiple academic studies have identified longer credit cycles, sometimes called financial cycles, that run 15 to 20 years. These longer patterns track the build-up of private sector debt relative to GDP. By that measure, we are potentially approaching an inflection point where accumulated leverage becomes problematic. The key question for borrowers and investors is not whether a credit contraction will occur, because history shows that it will eventually. The question is whether current conditions represent early cycle, mid-cycle, or late cycle. Early and mid-cycle are generally good times to take prudent leverage and make growth investments. Late cycle is when conservative positioning, termed-out debt, and capital preservation become priorities. Several indicators suggest we may be in mid to late cycle. Credit has been easily available for several years. Lending standards have eased significantly from post-crisis tightness. Covenant-light loans dominate the leveraged loan market. Private credit has grown explosively with limited default experience. Real estate prices in many markets have fully recovered and exceeded previous peaks. Corporate debt relative to GDP is at record levels. These conditions don't guarantee an imminent credit contraction, but they suggests the expansion is mature rather than young. At the same time, some factors argue for continued stability. The Federal Reserve is easing monetary policy rather than tightening. Core inflation is moderating toward the Fed's target. Unemployment remains low. Bank capital positions are strong relative to the pre-2008 period. Regulatory requirements implemented after the financial crisis have made the banking system more resilient. These factors create buffers that may extend the credit cycle beyond what historical patterns alone would suggest. For practical decision-making in 2026, several guidelines emerge. Businesses should prioritize balance sheet strength over aggressive growth, financed with leverage. Lock in long-term fixed-rate financing if available at acceptable rates, even if current floating rates might be slightly lower. Maintain flexibility with liquidity and covenant cushions. Avoid debt-financed acquisitions or expansions unless the investment generates cash flow quickly enough to service the debt under adverse scenarios. Real estate investors should be particularly cautious about floating-rate debt and short-term financing. The reset risk is substantial when cap rates have expanded and property values are under pressure in many markets. Long-term fixed-rate debt, even at higher rates, provides certainty and eliminates refinancing risk. In markets where properties are trading at high valuations with low cap rates, consider whether projected rental growth and value appreciation are realistic or are based on assumptions of continued easy credit and low interest rates. Borrowers at all levels should understand that credit availability can change far faster than most people expect. Markets that appear liquid and well-functioning can freeze within days when confidence erodes. Having credit facilities in place before they're needed is essential. Waiting until credit is needed and then discovering that lenders have pulled back is a situation that destroys businesses and investment portfolios. The 7-year credit cycle pattern is not a precise timing mechanism. It's not a countdown where we can mark a calendar and know exactly when conditions will shift. It's a recognition that credit systems have inherent instabilities that build over time and eventually require correction. The expansion phase creates incentives for increased leverage and risk-taking. Lenders compete for market share by easing standards. Borrowers take advantage of easy terms to increase debt loads. Asset prices rise, which seems to validate the increased leverage. This continues until something breaks, a shock occurs, defaults rise, and lenders pull back simultaneously. The contraction phase then eliminates excess and resets the system. Weak borrowers default. Over-leveraged positions get liquidated, asset prices correct, and credit standards tighten. This is painful but necessary for system health. It clears out the speculation and the unsustainable leverage. Eventually conditions stabilize, capital returns, and a new expansion begins. The entire cycle takes years to complete, with the expansion phase typically lasting longer than the contraction phase because building leverage takes time while unwinding it happens quickly. What makes the current environment particularly interesting is how much policy intervention has shaped the credit cycle. The Federal Reserve's willingness to provide liquidity during stress, to cut rates aggressively, to purchase assets directly, has prevented several potential credit contractions from fully playing out. The 1998 crisis was contained partly through Fed rate cuts. The 2020 crisis was met with unprecedented intervention. This creates moral hazard, as market participants believe the Fed will prevent severe credit contractions, which encourages additional leverage and risk-taking during expansions. At some point, this dynamic creates a situation where the accumulated leverage and distortions are too large for policy to offset without creating other problems. Japan's experience over the past 3 decades demonstrates how prolonged easy money policies can lead to zombie companies, misallocated capital, and low growth. The European Central Bank's negative interest rate policies had similar effects. The question facing the US and global economy is whether we have reached that point, or whether additional policy space remains to manage through the next credit stress. For individuals and businesses making decisions now, waiting for perfect clarity is not an option. Economic conditions are inherently uncertain, and credit cycles are visible primarily in retrospect. The goal is not to predict the future precisely, but to position conservatively enough to survive adverse scenarios while maintaining enough flexibility to capitalize on opportunities. That means avoiding excessive leverage, maintaining liquidity buffers, and being prepared to act when others are frozen by fear or lack of access to credit. The patterns, from 1980 through 2025 demonstrate that credit cycles are one of the most powerful forces shaping economic outcomes. Understanding where we are in the cycle, recognizing the signs of expansion and contraction, and positioning accordingly separates successful long-term investors and business builders from those who get caught in the inevitable reversals. The cycle will continue, credit will expand and contract. Being on the right side of those movements makes all the difference. If this exploration of credit cycles has changed how you think about borrowing, lending, and timing major financial decisions, then you've started to see patterns that most people miss. These aren't academic theories. They're practical realities that affect whether your business thrives or struggles, whether your real estate investments build wealth or create problems, whether you're positioned for opportunity or caught in the next contraction. Subscribe to keep exploring these patterns, because understanding how the economic machine really works is how you build sustainable success in an uncertain world. The credit cycle doesn't care about your plans, but understanding it lets you plan around its rhythms, and that's the difference between hoping for the best and being prepared for whatever comes next.